Get your free copy of the complete tutorial at www.teachucomp.com/free.
While there are many types of professional entities, the most common forms of business are the sole proprietorship, the partnership, and the corporation. When you start your business, you must decide what type of business you are forming. Consulting with a lawyer, an accountant, or even a tax preparer is a really good idea at this point, as legal and tax considerations are a large part of deciding what form of business to create. A sole proprietorship is an unincorporated business that is owned by an individual. It is the simplest form of a business organization and is also the one where most small businesses start. As the owner of a sole proprietorship, legally the business does not exist apart from you. Therefore, litigation brought against the company can also place at risk your own personal assets. Using this type of structure, the liabilities of the business are your personal liabilities. The assets of the business are also your assets. The income and expenses of the business are included on your personal tax return. For more information on sole proprietorships, see IRS Publication 334, Tax Guide for Small Business. If you are a farmer, see IRS Publication 225, Farmer's Tax Guide. A partnership is the relationship that exists between two or more individuals who join together to carry on a trade or conduct business. Each person in the partnership contributes money, property, labor, or skill to the business and expects to share in the profits and losses of the business. Partnerships must file an annual return to report income, deductions, gains, and losses from the year's operation of the business. However, the partnership does not directly pay income tax for the income earned. Instead, any profits and losses are passed directly to the individual tax returns of the partners. Each partner will then include their share of the profits or losses on their individual tax returns. For more information on partnerships, see IRS Publication 541, Partnerships. Generally, when a corporation is formed, prospective shareholders exchange money, property, or both for a share of the corporation's capital stock. The corporation is a separate legal entity that exists apart from the individual shareholders. A corporation will generally take the same deductions as a sole proprietorship in order to figure its taxable income. There are also special deductions that corporations qualify for as well. You will also want to consult with an accountant or tax preparer to discuss these deductions. The profit of a corporation is directly taxed when it is earned. The profit is taxed to the shareholders when the profit is then distributed as dividends. However, shareholders cannot deduct any losses that the corporation incurs. For more information on corporations, see IRS Publication 542, Corporations. An S corporation is a type of corporation that, if eligible and located in the United States, can avoid the double taxation that often occurs with the traditional corporate structure. An S corporation is exempt from federal income tax, other than tax on particular capital gains and passive income. On an S corporation's tax return, shareholders include their share of the corporation's stated income or losses, along with their share of non-separately stated income and losses. For more information on S corporations, see the instructions from Form 2553, Election by a Small Business Corporation, and Form 1120S, U.S. Income Tax Return for an S corporation. A limited liability company, or LLC, is an entity formed under state law by filing articles of organization as an LLC. Members of an LLC are not personally liable for any of the LLC's debts. An LLC can be classified for federal income tax purposes as a partnership, a corporation, or an entity disregarded as an entity separate from its owner. For more information on LLCs, see the instructions from Form 8832, Entity Classification Election.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.